The Malaysian economy expanded by 4.7% in the fourth quarter of 2018. Growth was supported primarily by resilient private consumption. The impact of disruptions in commodity-related sectors in the second and third quarter of 2018 have also receded. This improvement has provided some support to growth. On the demand side, private sector activity continued to anchor growth. Private consumption registered a robust growth of 8.5% in the fourth quarter. Household spending was supported by income and employment growth, with additional impetus from government measures to alleviate cost of living, such as the special payments to civil servants and pensioners. Firms continued to invest, although at a slower pace. On the supply side, services and manufacturing sectors, which account for close to 80% of GDP, remain the key drivers of growth. The services sector was driven mainly by growth in the wholesale and retail trade subsector. The manufacturing sector growth was supported by continued expansion in the E&E and transport-related production. For the full year 2018, the Malaysian economy grew by 4.7%. The growth performance is highly respectable, reflecting resilient private sector spending, support from net exports, and continued expansion in the manufacturing and services sectors. These factors offset the supply disruptions in the commodity-related sectors, the rationalization of government spending, and a challenging external environment. The current account surplus widened to 10.8 billion ringgit, or 3% of GNI in the fourth quarter of 2018. This was on account of a higher goods surplus and a smaller income deficit, which more than offset the larger services deficit. The goods surplus of 33 billion ringgit was due primarily to stronger manufactured exports in both the E&E and non-E&E segments. For the full year of 2018, the current account balance registered a surplus of 2.4% of GNI. For 2019, global growth will move closer to its longer-term trend. There will be negative spillovers from the global trade tensions, and we have built this into our forecast. But there will be other factors that will sustain headline growth, such as commencement of RAPID, which is the oil refinery and petrochemical complex. There are new E&E facilities, for example, the automotive semiconductors, biomedical, aerospace. There's also retail outlet expansions, and there is going to be sustained domestic demand, which encompass private consumption, civil engineering projects such as the MRT2, LRT3, and Penbonio. There will also be recovery from the supply-side disruptions in gas production. And some of the high approval manufacturing investment figures will also be translated into actual investments in 2019. All in all, while there are downside risks, the baseline forecast for 2019 is for the economy to remain on a steady growth.
With tanks and guns, this time tariffs and Twitter feeds the ammunition in the latest escalation of a bitter trade dispute between the US and China.
We aren't looking at a broad and deep market sell-off. We're looking at all of the majors off by some 2% or more. And in fact,
markets reeled as Beijing reacted to the latest bout of US tariffs by fighting back, hiking taxes on $60 billion worth of key American imports. Think beans to Budweiser. The two premiers had been on course to bury the hatchet, but late last week talks broke down after China's President Xi Jinping declared he wouldn't give in to President Trump's demands to enshrine new trade laws. The deal called off, President Trump resorted to his favourite negotiation.
Since the US and China are large economies, their trade disputes not only affect each other, but also the global economy. In general, countries which engage in intermediary trading between US and China, would face the negative impact of the dispute. South Korea, Taiwan, Vietnam, and Malaysia, all of which export goods such as machine parts and components for communication equipment used in the production of items that China then sells to the US, are certainly vulnerable. The trade war is important to agriculture because China has been US' top agriculture export market with an annual sale of nearly US 20 billion last year. Top US agriculture export to China include soybean, cotton, fish, dairy, sorghum, wheat, and pork. What does this mean to Malaysia's agriculture industry? China is the world's largest buyer of soybean, importing 60% of the traded crop, which it uses primarily for animal feed and vegetable oil. With China's new 25% tariff on American soybean, a substitute for palm oil, this will be a boon for Malaysia to expand her palm oil export to China. China's higher tariff on the US pork products with the US $3 billion worth of tariff would also be a good opportunity for alternative suppliers like Malaysia. As palm oil exports are facing challenging market conditions, Malaysia has to improve its competitive advantage in the global markets other than strategizing in market penetration, such as through collaboration memorandum and market promotion in China. The industry should also improve its production efficiency through labor saving and land augmenting technology. The progress in tree mechanization has hitherto been relatively slow. With increasing shortage and rising cost of labor, there is a need to intensify research in this area.
Today, there's a wide disparity between estates and smallholders, yet the poor performance of the smallholder sector is attributed to non-optimum production and financial constraints. Farm management practices are below the recommended ones. Thus, agronomic management to improve the smallholder farming system must be emphasized to improve yield. An inventory to determine technology transfer and adoption among smallholders and factors that influence technology adoption should also be undertaken. In the long run, however, the trade war would have a negative effect on gross domestic product, manufacturing, employment, and trade, both in the US and China. Smaller nations within Asians would also see significant negative impact in terms of GDP, manufacturing, production and employment, export, import, and total trade, since these nations are highly trade dependent.
Economic growth means an increase in real GDP. The benefits of economic growth include higher average incomes. This enables consumers to enjoy more goods and services and enjoy better standards of living.